Right now it's time for us to talk money because we are already in February, and as the South African tax year draws to a close, many say that it's a good time to review your financial plan as well as maximize on your retirement fund contributions. Now, the government's recent signing off of amendments to the tax law has caused some controversy, and here to clear up the air is certified financial planner Grant van Zyl. And of course, these tax legislations changes will come into effect on the 1st of March. But what are the pros and what are the cons, and how can you make the most out of it to make it work for you? Grant will also be answering some of your personal finance questions, so give us a call on 083-9133-728. Grant, always good to have you here, man.
Yeah, thanks, man. It's always good to be back.
Yeah, I remember hearing about this on a radio interview, and I thought, these changes that the tax law is bringing about, are they good or bad?
Well, in my opinion, I think they're fantastic. I think there's some parties out there that disagree, but I think when it comes to South Africa, getting us to practice saving or paying attention to it is only going to be better for everyone.
Yeah,
you know?
Especially given that we have been saying it over and over again, we are the worst saving nation in the world.
Yeah.
So it's being said that these changes will affect pensions, retirement annuities, and perhaps most significantly, provident funds, right?
Yeah.
And I know we spoke about it last week, but let's just quickly rehash the difference between those three investment propositions.
Okay, cool. So let's use an example to make it as simple as possible. So let's say you make 100 Rand a month. The government is saying that you can take 15% of that at the moment and put that into a savings vehicle called a retirement annuity, a pension fund, or a provident fund.
Okay.
Now, what that means is you're no longer taxed on the 100 Rand, you're only taxed on the 85 Rand.
Yes.
Okay, so that's the first advantage of these vehicles. The pension fund is exactly the same as retirement in that retrospect. When it comes to retirement, both pension fund and RA, 1/3 you can take as a cash lump sum. The first 500,000 rands tax-free. The rest, you have to put in, the 2/3 you have to put into what we call a living or life annuity, and then you draw a income from that. A provident fund, however, is a little bit different, where only contribution that's tax deductible is the employer's contribution. And at retirement, as it currently stands, the full lump sum at retirement you can take as a benefit.
Yeah. So speaking then about these changes that come into effect on the 1st of March, how would they affect each one of these retirement annuity, pension fund, and provident fund?
Okay, so the first big change is the 15% is going up to 27.5%.
Okay.
Up to a maximum of 350,000 Rand a year. So you can see
that which you can contribute every single year that is tax deductible.
So let's go back to the example. If you got 100 Rand a month that you earn, you can put 27 Rand 50 into that savings vehicle. So then you're only taxed on, 73 Rand per month instead of 100 Rand. Okay. Second, the major differences though are around the provident fund. So at the moment, the provident fund, you cannot, the employer's contribution is tax deductible. The employee can't get the tax deduction. That will change going forward. Okay. And then the new, the 1/3, 2/3 rule will then come into play for the provident fund going forward with all new contributions and the investment growth.
Okay.
The portion before that will still have that full lump sum benefit.
Fantastic. We'll continue our chat a bit later on 083-913-3728. Our lines are now open and Grant will be taking your calls. But for now, here's Ewan.